We hear about the Silicon Valley dream all the time, the billion-dollar unicorn built in a garage. But the math tells a much darker story. 9 out of 10 startups crash back down to earth. This chart tracks the startup survival curve over time. It shows a steep drop-off right out of the gate. 20% of new businesses vanish in year 1. By year 5, half of them are completely dead. These failures aren't the result of random bad luck or unpredictable market weather. When reviewing the postmortems of thousands of dead companies, you see the exact same patterns repeating. They die from a specific set of measurable mistakes. This bar chart ranks the ultimate causes of startup death. The number 1 killer, at 42%, is building a product nobody actually wants. The second fatal error is running out of cash. 29% of startups burn their funding before fixing their core product. Because these companies die from identical errors, we can use their autopsies as a literal blueprint. By studying exactly how they crashed, founders can engineer their own survival. Look at Quibi. The leadership team raised a massive war chest of $1.75 billion to create premium, short-form video for mobile phones. They assumed millions of people wanted Hollywood-level production quality in 10-minute chunks. But they launched broadly without ever testing a minimum viable product, a small, stripped-down version of the app meant to validate whether users actually care. Consumers didn't care. 6 months after launching, facing total consumer apathy, Quibi shut down its multi-billion-dollar empire. Contrast that arrogance with the agility of Slack. The founding team originally built a video game. The game was dying, but they noticed something else in the process. They had built an internal chat tool to communicate while coding. They realized the chat tool was the real product, pivoted their entire business model, and reached a massive valuation. Airbnb did the same thing, iterating heavily on low-tech prototypes like selling cereal boxes and renting out air mattresses just to survive their early days. No amount of venture capital can artificially create demand. Survival requires building what customers demonstrably pay for, not what founders dream up in secret. The second major startup killer is cash exhaustion, which almost always comes from the dangerous decision to scale up prematurely. The Chinese bike-sharing company Ofo expanded its bright yellow fleets into over 250 cities worldwide at the exact same time. They completely skipped proving their unit economics. That means they never figured out how to make a profit on a single bike ride in a single city. As a result, they burned through $2.2 billion simply replacing broken inventory. This growth at all costs mindset inevitably breeds hype and bad governance. WeWork is the prime example. The company signed massive long-term property leases while renting desks out short-term. The founder operated with virtually no board oversight, burning cash so fast that their initial public offering completely collapsed. When hype outpaces reality, some leaders resort to faking milestones. Babylon Health touted an AI doctor that couldn't reliably diagnose patients. Theranos went even further, committing outright fraud to hide a blood testing technology that simply didn't work. Premature scaling is fatal. Long-term growth strictly requires proven, profitable unit economics and a board that demands transparency. This decision tree is a founder's ultimate defense against building the wrong product. It all starts with one question. Do you have product-market fit? If the market rejects your initial offering, you must loop back to the customer. You gather feedback, refine the product, and test a new prototype. You completely refuse to scale your business until that fit is verified. Once you find that fit, you need a rigorous dashboard. You cannot rely on vanity metrics like press mentions or social media followers. You survive by tracking real numbers. You must monitor your customer acquisition cost, how much you spend to get one user, against their lifetime value, the total revenue you expect from them. If the lifetime value doesn't significantly outweigh the acquisition cost, your business model will break. Tracking objective data separates real companies from cash-burning projects. It is the only definitive way to know your business is viable. Let's look at the funding data in this split-screen graphic. Purely bootstrapped ventures face a 92% failure rate. But even with deep pockets, venture-backed startups still fail 75% of the time. The golden rule for extending your runway is to bootstrap your earliest days. You prove product market fit with your own lean resources, and you only raise external capital after validation to fund your scale. You also need to build a balanced founding team. Bringing together technical, operational, and sales skills directly prevents the 23% of failures caused by poor team dynamics. To prevent sudden collapse, you execute basic risk mitigation. Diversify your revenue streams, secure 12 to 18 months of financial runway, and handle your legal compliance early to protect your intellectual property. Beating the 90% failure rate doesn't require you to be a lone, visionary genius. It requires the humility to listen to the market, the discipline to track your data, and the focus to execute a proven playbook. To implement these strategies today, download our free startup checklist, join the Skillonize webinar, and subscribe for more data-backed founder advice.